This is the story of how United States agriculture entered a 5-year collision between farm bill delays and tariff uncertainty. Federal support expanded year by year, yet financial pressure still moved outward from farms to suppliers, lenders, exporters, and consumers. We will follow the sequence from the oldest evidence to the newest, rank the impacts from lower to extreme, separate what can still be managed from what is becoming hard to reverse, and close with practical actions for each group in the chain. The story starts with one simple reality. Farm outcomes in this cycle are not driven by yield alone. Two engines have been running at the same time: domestic policy design and timing on one side, export access and tariff clarity on the other. Once one engine slips, margins tighten, and when both engines shake at once, cash pressure rises faster than most operations can absorb. That pattern runs through every chapter of this timeline. In 2021 and 2022, stress was already building under the surface, even when headline conversations still sounded manageable. Input costs climbed, fertilizer moved sharply, and labor costs sat 47% above 2020, which meant operating budgets were carrying more weight before any full policy reset arrived. As costs rose and financing conditions tightened, producers had less room to wait for policy updates. Planting decisions still had to be made, loan decisions still had to be made, and every delay in policy adjustment started to matter more. By 2023 and 2024, pressure shifted from temporary strain to structural uncertainty. The 2018 Farm Bill had expired and kept running through extensions. Programs stayed in place, but the framework was not fully recalibrated for inflation, trade friction, and higher financing costs. This was the moment the system began operating on mismatched clocks. Farms planned by season, lenders managed by repayment cycles, and policy moved by extension windows. Late in 2024, the American Relief Act pathway extended the prior framework again and added emergency support near $31 billion, including disaster and economic assistance components. The result was immediate stabilization, but the deeper message was different. Crisis response had become part of normal policy function. Then 2025 arrived with a much larger support structure through the OBBBA. Reference prices for major commodities increased by roughly 10 to 21%. Crop insurance support expanded, and base acre capacity opened up to 30 million acres. At first glance, it looked like the system had finally caught up. The next chapter showed why pressure did not disappear. Enhanced A, R, C, and PLC support faced a timing gap, with full disbursement flow tied to October 2026 at the start of fiscal year 2027. Operating seasons could not wait for that clock, which meant farms still needed cash before statutory support could fully land. That timing gap led to another bridge layer: farmer bridge assistance at $12 billion, split between $11 billion for row crops and $1 billion for specialty crops, with enrollment opening in late February 2026. The bridge kept operations moving, while confirming that real-time liquidity demands were outrunning policy timing. Trade pressure was tightening in parallel, and this is where the story moved from policy design to execution risk. In 2025, machinery imports dropped by roughly 10 to 24%. Tariff-affected fertilizer imports fell 47%, and Gulf DAP rose from $583 per ton in January 2025 to nearly $800, about a 36% jump. Then came the legal shock in February 2026. The Supreme Court ruled 6-3 that IEEPA did not authorize broad peacetime tariffs. Effective tariff estimates in this research moved from 19.6% before the ruling to 9.1% after it, and the policy path quickly pivoted to alternate authority, including Section 122. That pivot introduced a temporary global duty structure at 15%, with a statutory window near 150 days. A short window like that changes behavior quickly. Buyers can delay commitments, contracts can pause, and execution risk spills into storage pressure, basis pressure, and cash flow timing. In the same February window, House Agriculture released the Farm, Food, and National Security Act of 2026 on February 13th and scheduled markup for February 23rd. Policy uncertainty and tariff uncertainty were active at the same time, which is exactly the overlap this episode is about. The 2026 scoreboard makes the contradiction plain. Net farm income is projected near $153.4 billion, down 2.6% after inflation, while net cash farm income is projected near $158.5 billion and supported in part by federal injections rather than organic market strength. Direct government farm payments are projected around $44.3 billion, and one estimate in this research places net farm income around $109.1 billion without those payments, almost 12% lower. Support was larger, and risk stayed elevated. Working capital is projected to fall 9.2%, from about $154.9 billion to $140.6 billion. Total farm debt is projected near $624.7 billion, and debt to asset is projected around 13.75%. Bankruptcy pressure also moved higher. Chapter 12 family farm filings rose 46% in 2025 to 315 filings. Trade metrics told the same story from another angle. The agricultural trade deficit projection in this set is near $37 billion. Exports are around $169 to $173 billion, and imports are around $210 to $210.5 billion. Soy showed the shift in the clearest way. January through August 2025 shows United States soybean exports to China at 218 million bushels versus 985 million in the same period of 2024. June through August sat near zero, and August 2025 alone had China buying about 290 million bushels from Brazil, 85% of Brazil's monthly soybean exports. That is the turning point in the narrative. This is not a headline debate about tariffs alone. This is a chain reaction where policy timing, contract behavior, and market access all feed into financial outcomes. Now watch how the damage escalates, because in this cycle, it does not hit all at once. It usually starts as policy-making noise, with markup timing, title details, and implementation ambiguity around subsidy design, conservation, specialty crops, and credit. And that first stage mostly slows planning, tightens underwriting behavior, and raises inventory caution while consumers feel limited direct impact. Pressure gets heavier when tariff rules shift quickly in legal and procedural terms. Since the ruling changed one framework, the pivot changed the operating framework, and short validity windows made exporters, suppliers, and producers hesitate on contracts. From there, cost pressure begins doing direct damage to margins. Fertilizer, machinery, labor, and financing stayed expensive while output pricing remained soft in key categories. And one estimate in this research puts expected corn planting cost near $917 per acre in 2026, up $27 from the prior year. Once margins stay tight for long enough, stress moves straight into financing channels. Spending gets deferred. Dealer movement slows, supplier receivables stretch, and farms can look asset strong while staying cash thin in day-to-day operations. At that point, delinquency signals become hard to ignore, with survey data in this set showing 34% of lenders reporting higher production loan delinquencies versus 20% previously, 21% reporting higher real estate delinquencies versus 12% previously, and nearly 70% identifying grain operations as the primary concern. The final and most damaging stage appears when export displacement becomes structural, because once major buyers re-anchor routes, storage, and procurement through competing origins, lost market share stops behaving like a cycle and starts behaving like a new baseline. That full progression, from sequencing uncertainty to tariff whiplash, to margin squeeze to credit stress, and finally structural export loss, explains why larger support does not automatically produce stronger resilience. Severity by itself is only half the picture. Recoverability decides what still can be done. Part of this risk is still controllable right now, if cash protection starts early, through liquidity-first budgeting, base stress severe operating plans, and shorter hedging windows around policy events. While suppliers tighten inventory turns, exporters diversify destination exposure where possible, and lenders update stress assumptions to current profitability realities. A tougher layer sits in buyer confidence and contract reliability after repeated policy reversals. Because trust can return with predictable execution, disbursement lag can be reduced through implementation choices, and structured rollover credit can still work when deterioration is detected early. The hardest layer is permanent share loss after routes, contracts, and buyer routines shift away from United States origin, since income support can cushion the damage but cannot rebuild demand architecture on its own once that architecture has moved. 3 issues need immediate attention in this cycle. Working capital erosion before the next operating window comes first. Contract uncertainty inside short tariff windows comes second, and refinancing quality in grain-exposed regions comes third. If those 3 points deteriorate together, manageable stress can become forced consolidation. That is where this story goes from policy discomfort to structural change. Now, the actions by entity, following the same risk sequence from immediate to hard to reverse, start at the farm gate because liquidity pressure appears there first, and farmers need cash protection before anything else. 3 operating cases, base, stress, and severe stress, should be tied to trigger points for input purchases, forward sales, and hedging, while crop mix decisions should be tested against financing cost rather than yield alone, since staying liquid through volatility matters more than chasing expansion. One step downstream, input agribusinesses and dealers need balance sheet defense that works under more than one tariff path. Receivables discipline and tighter inventory turns are immediate moves. Procurement plans should be ready for both fast cost relief and fast cost rebounds. And the harder, medium-term challenge is extending customer credit without quietly absorbing the next wave of cash stress. Where contracts meet global demand, traders and exporters need optionality before certainty. Timing flexibility, destination diversification where feasible, and close tracking of weekly export sales against monthly trade shifts reduce execution risk now, while the difficult part is rebuilding buyer confidence after repeated policy reversals and short legal windows. For lenders and co-ops, the first move is early intervention before collateral optics hide cash stress. This research already shows pressure building, with 34% reporting higher production loan delinquencies, 21% reporting higher real estate delinquencies, and nearly 70% identifying grain operations as the top concern. So triage should focus on working capital runway, receivable aging, and grain exposure first. After that, refinancing needs hard triggers and realistic downside pricing assumptions, because once intervention comes late and covenant stress has already hit, workout costs rise fast and consolidation risk accelerates. For policymakers, the fastest stability gain comes from timing clarity and legal durability. Support aimed at stabilizing production has to align with real operating cash cycles. Tariff strategy has to be predictable enough for counterparties to contract without waiting out uncertainty windows. And implementation credibility across subsidy design, conservation, specialty crops, and export access has to be rebuilt through consistency. At the consumer end, retailers and food chain stakeholders need category-level affordability monitoring and targeted response where pass-through pressure is strongest. This research set tracks large cumulative increases since 2020 in bread, lettuce, mayonnaise, and coffee, while wage growth did not fully keep pace. So protecting lower-income households from additional price shocks should be treated as part of system risk management. The ending returns to the opening premise. United States agriculture moved through a 5-year collision where support expanded, yet stability stayed uneven because policy timing, market access, and liquidity pressure kept moving in different directions. The highest risk path in this cycle is not one bad harvest. The highest risk path is a sequence where contracts pause, working capital declines, debt rises, and export share shifts into competing systems. Options still exist, but low-cost correction windows do not stay open forever. Track working capital as closely as yield. Track export execution as closely as headline trade announcements, and track policy timing as closely as policy size. Because in this cycle, uncertainty behaves like a financial variable that decides who absorbs losses, who survives, and who compounds forward.